Get ready, y'all, because I'm about to reveal the best and the biggest tax deductions available to homeowners right about now. Welcome to the channel. I'm Karan from Life Accounting, the #1 accounting firm for accounting education and services. Now, home ownership offers some of the best ways that you can save thousands of dollars on your taxes. And yet, every single year, homeowners miss out on these money-saving tax deductions simply because they don't know. But you're not gonna be one of them, because if you watch until the end of this video, you will know the best and the biggest tax deductions available to homeowners so you can benefit big time. Let's jump right into it. So the first deduction you're gonna wanna take is on your mortgage interest. That's right. One of the most significant tax deductions for owning a home is the mortgage interest deduction. This interest deduction applies to interest on loans used to buy, build, and improve your home. Now, speaking of improvements, qualifying improvements include additions and major improvements. So the mortgage interest deduction is limited to only 2 homes. That can be any combination of your primary home, your second home, your boat, or a vacation home. Now, if you happen to be Drake or Mark Zuckerberg and have more than 2 homes, be sure to take the mortgage interest deduction on the 2 properties that will create the biggest tax savings. For mortgages on or before December 15, 2017, $1 million is the debt limit for this deduction. And that's $375,000 if you're married and filing separately. For mortgages after December 15, 2017, $750,000 is the debt limit for the deduction, or $500,000 if married filing separately. Now, the best way to know how much you paid in interest each year would be to look at the form your mortgage servicer sends you each year. And that form is called Form 1098. Okay, the second biggest tax deduction you could take as a homeowner is on your mortgage points. Mortgage points, also known as loan origination fees, are extra fees you pay to your lender, typically to lower your mortgage interest rate. 1 mortgage point equals 1% of your loan amount. Now, if you paid points on the mortgage for your primary home, you might be able to fully deduct the points in the year they were paid. But on the other hand, if you paid points to refinance your mortgage or to purchase a second home, you will generally deduct the mortgage points over the life of the loan. So if you pay points to refinance a 30-year mortgage, you would deduct 1/30 of the total points paid each year. Now, say if you paid a loan off early, you can deduct the remaining mortgage points in the year you pay off the mortgage, unless you refinance with the same lender. Okay, the third deduction you should take, if it applies, is on private mortgage insurance. If you put less than 20% down or refinance with less than 20% in equity, lenders typically require you to pay monthly private mortgage insurance with your mortgage, also known as PMI. Now, if you're married filing jointly and make $100,000 or more in adjusted gross income, that deduction begins to phase out. And after $109,000 in adjusted gross income, the deduction disappears entirely. Currently, the private mortgage deduction ended in 2020, but it may get extended by Congress again, as it has in the past. We'll keep an eye on it for you. Number 4 on the list is property taxes. Now, the bad news is every state in the US has property taxes. The good news is you can deduct the state and local property taxes that you pay. But there are some things to keep in mind. The first thing is that $10,000 or $5,000 when married filing separately is the limit on the total amount of state, local, income taxes, and sales you can deduct. Secondly, to claim this deduction, you have to itemize. All right, let's talk about a credit. Number 5 on the list is the residential energy credit. If you didn't know, Uncle Sam likes energy efficiency. So much so that you can get a tax credit when you install appliances or make improvements that boost your home's energy efficiency. Examples of qualifying appliances or improvements include windows and doors that are energy efficient and solar powered water heaters and roofs. The tax credit is based on the cost of the equipment, including installation costs. Here's how the tax credit works. You get a 30% credit for systems placed in service by December 31st, 2019. You get a 26% credit for systems placed in service after December 31st, 2019 and before January 1st, 2021. And then it drops down to 22% for systems placed in service after December 31st, 2020 and before January 1st, 2022. Now, don't miss this because the residential energy credit expires at the end of 2021. So if you're thinking about going solar or installing energy efficient appliances, do it before the end of 2021. Note that existing homes and new construction qualify for energy credits, but rental properties do not. All right, number 6 on our list for the biggest and best tax deductions for homeowners is the home office expense. If you own a business and use a space in your home that's dedicated and regularly used to conduct that business, you may be able to deduct related expenses. And the best part is that the type of home you live in, or whether you rent or own, does not matter. If you meet the guidelines, here are 4 everyday home office expenses that are deductible. The first is utilities. Think electricity, gas, internet, and your phone bill. Next, your HOA. Then your homeowner's insurance and cleaning supplies and services for your business space. You can also write off expenses for repairs or upgrades you make to your home. Unfortunately, the home office deduction does not apply if you are a remote employee and work from home. Now, if you'd like to learn more about home office deductions, I made an entire video on this subject, and I'll link it in the description below. All right, number 7 on our list is medically necessary upgrades and equipment. You see, if you install equipment or modify your home for medical purposes for yourself, your spouse, or a dependent, you may qualify for a medical expense deduction. Things like ramps, handrails, and lifts are typical examples of medical equipment and modifications that can qualify for the deduction. Additionally, the cost to maintain and operate the equipment and modifications are deductible as well. If the additional modification increases your home value, which most do not, the deductible costs are reduced by the increase in your home value. All right, number 8 on our list is capital gains. For most people, when they go to sell their primary home for a capital gain, they will be able to do so completely tax-free. And that's thanks to the Taxpayers Relief Act of 1997. Gains on the sale of your home up to $500,000 or $250,000 if filing single is completely tax-free. But there are some requirements. Here's how to qualify. First, you must own your home for at least 2 of the last 5 years. Secondly, you must have lived in the home at least 2 of the last 5 years. And third, you didn't use this exclusion in the last 2 years. Now, suppose you don't meet the requirements but had to sell your home because of work relocation, divorce, health problems, or maybe even unforeseen circumstances. In that case, you may still be able to eliminate a portion of your profits. Now, for good measure, let's look at a few costs that are generally not tax deductible for most homeowners. Things like mortgage costs, such as credit reports and appraisal fees, don't count. Depreciation, unless an investment property, doesn't count. Or forfeited deposits, down payments, or earnest money to secure the property also doesn't count. Well, there you have it. 8 tax deductions and credits for homeowners and home purchasers. I hope you found this video helpful. If you did, do me a favor and like this video. And then I want you to comment below if I did a good job of explaining. Also, don't forget to subscribe to our channel so you don't miss out on other videos we're putting out to help lower your tax liability. I'm Karan from Life Accounting. Until next time.